Hello, everybody, and thank you for taking the time out of your busy day to take part in our session today, What to Do with an Unwanted Life Insurance Policy. This is Michael Brohawn from ITM 21st. First, some housekeeping. You should have received the handbook for today's session. If not, it's on the website under Education at itm21st.com. That's itm21st.com. And CE for today is 1 hour for CFP, for CTFA, and also for FIRMA. Members of FIRMA can get 1 hour CE for their FIRMA credit. The CE form is on our website under this session info, and then after the session, you can always find the forms in the education section on our website. It's in the blue box at the bottom. If you have a question today, you can simply type it in, and I'll try to answer it along the way, but if it's something we're going to cover later, then I may just wait. It could well be that we will simply answer questions at the end, but do ask if you have a question. We've been very happy with the response for our ITM 21st University webinars. We have provided hundreds and hundreds of hours of CE, and we've had around 1,100 individuals sign up for our sessions. Many have signed up for a number of different sessions. And we have had a wide variety of interesting subjects with great presenters this year. Coming up on November 29th, Brad Davidson, the managing partner at Unique Asset Partners, will be here to talk about how unique assets should be valued in compliance with current regulatory requirements. Pricing these assets properly can be a challenge, and Brad will explain in non-technical terms who should value and also how to value these asset types, including real estate, closely held businesses, life insurance, minerals, oil and gas, loans and notes, intellectual property, and collectibles. In our last session before the holidays, Leon Wessels will join me on December 13th to talk about an issue we see in the marketplace more and more. Many TOLI trustees are looking to relieve themselves of the burden of at least some of the TOLI trust in their portfolio. Troublesome clients, troublesome policies, more than an acceptable risk. The reasons are many. This session will discuss the various issues that might cause a trustee to want to divest of these assets and provide the various methods that will allow the trustee to do so in an efficient and safe manner. This is a must-see session, especially for those trustees looking to make changes in 2017 and wanting to know about why, when, and how to move ILIT accounts out of your portfolio. We have a big agenda today. We're going to start by talking about the reasons why policies might be unwanted, reasons that have to do with the policy, the people surrounding the policy, the marketplace, and changes in the tax system. Then we will take a look from 40,000 feet, discuss a tool that should be used when dealing with policy discussions, especially in older age insureds, and that's a life expectancy report. And then Aaron Hanson, who heads up our remediation department at ITM 21st, will talk about specific situations that place you in liability. He will walk through some case studies adopted from real-life situations. And we're going to end on communication and documentation. One of the things I often mention and have not mentioned for a while is the fact that whenever we discuss policy management, we're typically talking about gray decisions, not black and white, clear decisions. Life insurance is a very peculiar financial tool, simply because the benefit is paid at a time that is unknown. It can be as far away as 50 years or even more, or it can be tomorrow. You can manage a policy correctly for 30 years, and then when the client is in his 80s and no longer insurable, you can have a cost increase like we have been seeing, and the policy seems to not make economic sense through no fault of your own. Or you can mismanage a policy completely, but if the insured dies prematurely, it may not even matter. And many of the decisions that you will make will not have a quote-unquote right answer. The truly best outcome is often outside of your control. But you can make a prudent decision based on the facts and circumstances that you can control and you know about, And as trustee, you must make sure that all facts and circumstances are taken into consideration. At times, I have seen that this is not always the case. So managing a policy is not easy, but if you follow a process, you can mitigate liability. So why are these policies unwanted? Well, there are a number of reasons. Some reasons are driven by the people, some by the policy, some because of things that occur in the market or with government. And the first reason is policy performance. We'll talk about this a bit more in detail, but in general, life insurance policies have not performed as had been expected. The fact is, when a policy is sold, oftentimes the expectation around the policy is out of line with reality, or at least the assumptions are nowhere near as conservative as they should be. The fact is, life insurance as sold illustrations, what you receive when you buy the policy, oftentimes create a false confidence. And policy failure, not living up to expectations, can lead to a change in what we call investment temperament. What kind of risk is the trustee willing to take? So we often see variable life policies tied to the equity market being replaced with a fixed investment policy type, or a fixed investment type policy that did not perform being replaced with a policy with a guaranteed death benefit, one that has zero market risk. Sometimes the grantor believes that he or she no longer needs the policy because their financial situation changed. We've had developers and builders with substantial net worth tied to real estate watch their net worth drop during the 07-08 meltdown. And sometimes grantors believe their wealth will grow much faster. They projected an estate tax issue that never materialized. Sometimes there's just a change in trust goals. We are living in an era of 2 and even 3 marriages with our clients, and as marriages come and go, the estate plans change dramatically. We also know that issues arise with beneficiaries. Maybe they're not so good with money. Maybe drug or alcohol issues rear their heads, and the death benefit in the trust could be an issue for them. We have run across this, sad, but it happens, and it alters the estate plans again. And certainly the change in the federal estate tax with the raising of the exemption amount is a huge issue, and we'll talk about that in a minute. But first, let's discuss policy performance. We are all living in historic times. Right now, 35% of government debt issued these days is at negative interest rates. Think about that. We are now paying governments to run a debt. It's amazing. Investors will buy a bond with a negative interest rate. And insurance carriers are limited in what they can invest in, primarily fixed investments, so they are stuck with these types of investments. The graph above represents the crediting rate in a universal life policy. When the policy was taken out, the assumption in as-sold illustration was a crediting rate that was higher than the return that was ever actually obtained. So policies did not perform, are still not performing, and some have lapsed. And the graph above would be very similar for whole life policies. Their dividends would show a downward slope. In fact, we just published a blog that noted that Northwestern Mutual, the gold standard of carriers, lowered their dividend rate and actually increased some expenses in their policies for 2017. So the low interest rates are having an effect, a negative effect, on life insurance policies. And that has led to one of the biggest stories of the last year or so, the cost of insurance increases we have seen from 6, 7, 8 different carriers. And these can easily make a policy unwanted. And in fact, the first case study that Aaron will show you will be based on this situation. On the screen and on page 3 of your handbook is the spreadsheet cost analysis of the policy Aaron will be talking about. Our New York City office can tear apart policies and show you costs down to the penny. And in that policy, we showed that the cost of insurance increase was 40%. But it more than doubled the premium solve needed to get to maturity. In other words, to keep the policy going to maturity, the grantor had been gifting $36,000 in change, but now $81,000 in change would be needed. The policy certainly can become unwanted, but you as trustee have to figure out how to get the maximum value for the beneficiaries. That is your job, and you are in charge of this $4 million asset. I think policy performance, along with the changes in the estate tax laws, are the 2 biggest factors generating unwanted policies. On the screen and on page 4 of your handbook, we show the increase in the exemption amount over the years. The exemption amount being the amount a person can pass on to the next generation before estate taxes are due. Over the last 20 years, that amount has grown from $600,000 in 1997 to $2 million about a decade later in 2006 to $5.4 million today. And obviously, this is a huge change, and the number of people subject to estate taxes has dropped over the years dramatically. So let's take a husband and wife with a $10 million estate. In a simple example, in 2001, that couple would together have an exemption amount of $1,350,000. So $8,650,000 would have been subject to a 55% tax rate, and they would have owed 4.7 and change in estate taxes. In 2006, that same couple with the same $10 million estate had a federal estate tax of approximately $2,760,000. That same couple this year in 2016 would owe nothing, since the exemption amount is above $10 million. So over the years, the number of people filing an estate tax return has dropped as the amount collected by the federal government. As you can see in your handbook on page 4 and the spreadsheet on the screen, in 2001, 110,000 returns were filed. That dropped by about 2/3 to 37,000 in 2007 and down to 11,000 in 2015, just 10% of the 2001 amount. It is interesting that the amount collected did not drop as much. The wealth in the U.S. apparently is getting more concentrated at the highest end, I assume. But certainly the number of people subject to the estate tax has affected our business, trust-owned life insurance. And with fewer people subject to the estate tax, you have more and more grantors with unwanted policies. So what do you do when one of your grantors, no longer thinking that they need the policy, comes to you and says they're no longer going to fund the policy, or maybe they say they're going to let it lapse, or they want you to surrender it? What do you do as a trustee responsible for maximizing the value to the beneficiaries? Well, first of all, you can do nothing. You can just let it run out of cash value and lapse. But if it's a whole life policy with loans, you could have a taxable event at that time. You can surrender the policy for its cash value, which may or may not be a taxable event, depending on the policy's cost basis. You can reduce the death benefit to an amount that will allow it to run to maturity, or at least past the insured's life expectancy. You can 1035 exchange the existing policy's cash value into a new policy tax-free. And this would make sense if the existing policy performance was poor and a replacement policy would perform better, or maybe because, as we mentioned, trust investment temperament had changed. Or you could sell the policy into the secondary market that has emerged for unwanted life insurance policies. That life settlement industry, or secondary market for life insurance policies, grew out of the viatical market. Sometimes these words, viatical and life settlement, are used interchangeably, but it's not really completely correct. Both are the sale of an existing life insurance policy to a third party, an investor, for an amount in excess of the policy's cash surrender value, but less than its death benefit. But the viatical really refers to a policy sale that occurs when the insured is a person with a terminal illness. Viatical sales grew out of the AIDS epidemic, and the growth of the industry led to what we refer to today as the life settlement market. In either instance, the seller receives a lump sum for the policy, and the buyer takes over management and premium payment on the policy. Today, investors, hedge funds, and large institutions buy tranches of policies as a quote-unquote non-correlated asset, an asset that has nothing to do with the equity or other investment markets. And we at ITM 21st actually manage policies for a number of these investors. One difference between a viatical, a sale to a terminally ill person, and a life settlement is that the tax advantages of the viatical sale are much better. the lump sum received for the policy in a viatical sale is tax-free for a terminally ill person. But for someone who simply sells his or her policy, taxes may be due. This industry has adapted and evolved to the point that there are actually opportunities to sell just a portion of the death benefit, but in most instances, an outright sale of all of the death benefit in the policy occurs. It has also adapted to the point that it is one of the most regulated industries around. So when should you consider this a life settlement? Well, anytime your client has decided to lapse or surrender a policy, you need to look at this option. Not every client who surrenders or lapses a policy is a prospect, however. The typical prospect is age 70 and up, though someone age 65 to 70 may qualify if there are health issues. And that's really the key here, as typically a prospect for sale has a life expectancy of 10 years or less, pretty much definitely under 15 years. The buyers, the investors who purchase these policies, particularly like universal life policies, current assumption universal life, are very popular. Because as we said, universal life policies, they're like living Excel spreadsheets. And we can break out all of the monthly costs. Index universal life and variable universal life are possible candidates if their cost structure is reasonable. Term insurance that is convertible to a universal life policy is often overlooked, but those policies are good prospects. Whole life insurance, however, is typically not a good candidate, but some whole life policies will qualify. It used to be that the best candidates were $500,000 and up death benefit policies, and larger policies of $1 million to $5 million were the ones that were the most coveted. But the market has dropped down a bit with small face market gaining traction, and there is a trend now for a direct-to-consumer pitch to try to find these smaller policies that might be in the $100,000 to $500,000 range. In fact, you might be seeing commercials on TV or the internet soliciting for these sales. One thing you have to realize if you sell a policy is that an investor who is going to buy that policy is looking to get a 15 to 20% annual return, and that is after they pay you and after they pay premium on the policy. So they will buy the policy, an expense, pay the premium on the policy until the insured passes away, another expense, and after all of that is factored in, they're looking to get a 15 to 20% annual return. Not bad. And that is one reason that in most instances, the only time you would want to sell a policy is when you're going to essentially allow the death benefit value of the policy to go away. A 2005 study references this idea when it says that if you keep the policy in force, even if the beneficiary, not the grantor, pays the policy premium, quote unquote, the return on the beneficiary's investments to preserve the life insurance contract is likely to exceed any other investment option. And this is important if you're trying to maximize value for the beneficiary, your client. The flip side is that according to industry information, there's about $112 billion in benefits left on the table each and every year by older Americans, money they can certainly use, but they lose just because they allow policies to lapse without looking at maximizing the value of the policy through a life settlement. And for trustees, that can lead to liability if you do not take a look at maximizing the value. Not everyone is comfortable with selling a policy, and there are downsides. The insured will be contacted after the policy is sold and may have to allow medical records to be gathered for years to come. And maybe they would not like this option, and neither would the beneficiaries, but the idea should be explored, and if turned down, it should be documented. We're leading up to Aaron walking through the 3 case studies that will bring this all to life, what you do when you come across an unwanted policy. But from 40,000 feet, let's just talk about the basics. If a client comes to you with an unwanted policy, first you need to review client expectations, needs, and goals. And the client is really the beneficiary. It may be that a cash-rich policy being surrendered is an asset that should be enjoyed now, if the trust document allows and if the circumstances warrant. But in order to make your decision, you need to develop a prudent process, and Aaron will be walking through that. And you need to make sure that the decision you make makes sense based on the best facts and circumstances available at the time. You need to dig in a bit and make sure you have all the facts. And in most cases, you will need the skill set to be able to look at alternatives. You need to know how to analyze all of the options available. Again, Aaron will walk you through this. And of course, as we always say, you need to document, document, document. I want to take a minute to talk about something that's vitally important to understand, and we've talked about this in past sessions. It is the cornerstone of prudent practices, and that is that compliance with the prudent investor rule, which we all live under as trustees or fiduciaries, is determined in light of the facts and circumstances existing at the time of a trustee's decision or action, and not by hindsight. It is your out as a trustee. Things can and do go wrong, maybe not work out the way you thought they would, maybe remember that this is a gray and not a black and white situation, so everything doesn't work out as expected. But if you developed a prudent practice and reviewed all options and made a prudent decision, you minimize chances you will be held liable if, and this is a big if, you document it all correctly and can prove your process. Now, last thing I want to talk about before we start the case studies, I want to talk briefly about one of the facts you should gather if you're dealing with anyone above age 75, and that is a life expectancy report. I just finished a book written by someone dealing with TOLI and managing liabilities, and throughout the book, the person mentioned life expectancy reports, and it was something that I haven't seen in a lot of different places, but I was happy to see. It's actually used by investors when they are trying to decide on the prices to offer for a policy, or even if they should make an offer. So investors use this tool. It's a scientific-based fact that should be part of a prudent practice when working with policies on older age insureds. What it is, a life expectancy report estimates the average number of years a person is expected to live based on their age, gender, lifestyle, smoking status, family history, and medical conditions, which is what we refer to as their underwriting factors. The life expectancy report includes the life expectancy estimate as well as the probability of mortality each and every year based on the insured's specific underwriting factors. It does not tell you the date of death. It gives you a range that provides useful information. The report plots the expected death of 1,000 people with the same underwriting characteristics, age, etc., as the subject of the report, and then plots those deaths in a bell curve. The median life expectancy is the point at which half of the 1,000 would have been expected to pass away. Also included in the report is a table that shows the accumulated deaths year to year. It's the same information shown in the mortality curve, just shown in a table form. But from it, you can easily see the numbers of people that are projected to have passed each year. So for example, in the table on your screen and in your handbook, 25% would have passed by year 5, 50% by year 7 and 8, that's the median line, 70% by year 10, and 90% by years 12 to 13. The subject in this case is now 81, so by age 94, 90% of those with the same age and health characteristics of the subject would have passed. Now what's the key here? The key is you can plot the expectation that the subject would have passed on at any point in time, giving you another fact to add to your decision-making process. In other words, by year 7 or 8, there would have been a 50% chance that your client would have passed on. Remember, one of the reasons for the gray is the fact we don't know exactly when someone will die, but an LE report gives you direction. Someone's asked a question. I'm going to just jump in. The question is, and I'm going to jump in because we talked about it a minute ago, is a convertible term policy on a 40-year-old a marketable policy? Well, convertible term policy is a very, very marketable policy. A convertible term policy on a 40-year-old, not so marketable, because again, most life settlements are going to be people above age 65 or 70 and people with a shortened life expectancy. So to answer that question, if you had a 40-year-old who had a life expectancy of maybe 10 years or less, that would be a policy that you could sell, possibly, but it's also a policy, going back to what we just talked about, it's also a policy that the beneficiary or the grantor would be well advised to keep and just pay the premium on. So getting back to life expectancies, it's a very useful tool. And what I wanted to point out, because a lot of people don't understand what you have to do to get a life expectancy report, and they think it's kind of like underwriting for life insurance. It's nowhere near that. The great thing about the life expectancy report is there's very little your client has to do. All that's needed is a signature on a HIPAA form, and that enables the underwriter to gather the medical records. There's no doctor visit for your client, no phone calls to the client. It's actually very unobtrusive, very easy for your client. And typically, the total cost, even if you have to pay for all of the records gathered, is about $500. A life expectancy report's about $350, and then there may be additional fees if the doctor is charging to gather those health records. So if you're managing an asset that is worth hundreds of thousands, even millions of dollars, a $500 expense does not seem like much if you are trying to manage it prudently. In fact, I'm actually surprised it's not used more in financial planning, as the #1 fear of clients seems to be running out of money, but that's a subject for another day. I brought this up because it is a useful tool and one that will show being used in one of Aaron's case studies. So let's get to those case studies. Aaron Hanson heads up our remediation department in Iowa. It's a service that sets us apart from others in the field because we actually help trustees deal not only with problem policies, but with any changes on a policy. So it does not have to be that there's a performance issue on a policy, just that there's a question. And if there is, our clients can call Aaron and his team, and they put together the information that's needed to make a good decision, a prudent decision. So let me hand it over to Aaron to take you through those case studies. Aaron?
Yeah. Hey, thanks, Mike, and thanks, everyone, for taking the time to join us today as we walk through a few of these example cases and situations that we see really quite often. Now, to start, and to reiterate what Mike had said when we went over the COI increases that have occurred with 7 to 8 carriers lately, when a request is received to review any policy for any reason or policies, there are several things that we need to consider, including what type of policy are we looking at, who's the carrier, are premiums required, what is the insured's age, what is the current projection. And now the options available will vary by policy type, so it's vital to know the policy type and understand that policy. For instance, if it's a term policy, what's the level period? If it's a whole life policy, what are the non-forfeiture options? Is the loan option present? So if premiums are not paid, we know that the premium would be paid by policy loan. Is there a term blend? Is it a universal life policy? Is it have a guarantee or no lapse? So these are all things that we consider and review whenever there's a policy review request that comes through, as each presents its own different set of options along with flexibility. Now, also important is the background surrounding the particular trust and policy. You know, is it a surrender request? That's generally an easy thing for someone to request. In their head, they know they have a policy with cash value, and I just need the cash value. Or they think that that's their only option. You know, maybe they're wanting to cease paying out-of-pocket premium, or maybe they're unresponsive and are not replying to the request for premium or gifts for the trust to pay premium, or potentially maybe the premium is just later skipped. Along with these lines, we get into, you know, what is the health of the insured? You know, the more background that's provided up front, the better, as this helps really focus the review in the right area. Now, with this case #1, we have a situation where the grantor was no longer gifting to the trust to pay premiums, using cash value to cover the monthly deductions on this current assumption universal life policy. And then a notice is received regarding the cost of insurance rate increase that will be coming. And in this case, it is a Transamerica policy. Now, this policy was issued in the early 1990s. Like I said, is a current assumption universal life policy where the performance is really directly tied to the non-guaranteed elements that will fluctuate, so they do change. Now, Transamerica sent the notice regarding the increase to the monthly deduction rates, and the increase was approximately 38%. Now, with the understanding that the grantor would not be making any additional gifts to the trust to pay premium, the trustee and client are now faced with what options are available, what should our next steps be. Now, reviewing the policy details, what we have is a $4 million current assumption universal life policy. It's currently in policy year 27. The male insured, now age 79, is in good health. He has paid in approximately $1.3 million in premiums to date. And that is currently funded, or up until the point of the cost of insurance increase, with enough cash value to keep this policy in force to right around his age 94. And now there's no additional plans or desire to make any additional gifts to the trust to pay future premiums, nor do the trust beneficiaries have a desire or the means to pay any additional premium. Also thrown in that the policy has a cash value of approximately $1.9 million. Now, with the new projections, which reflect the increase to the new monthly deduction rates, the policy is now projected to lapse 5 years earlier, age 89. So, in a sense, in the blink of an eye, the trust, the insured, the grantor, have seen a policy that they thought had funded adequately to get to an age that all were comfortable with, age 94, to the next day realizing that they've just lost 5 years at no fault of their own or the trustees. So that brings us up for options. What are our options in a situation like this? The first option would be no change, you do nothing. We know the policy projections have changed, now lapsing at age 89 based on the new COI rates. And no additional out-of-pocket premium would be required, and the policy runs approximately 10 more years to the insured's age 89. This in turn also would be of no change to the $4 million death benefit that's currently present. The second option would be resume paying premium. And we know in this case the grantor had no intention and no desire to pay premiums. So this option is reviewed, but ultimately not realistically considered based on the goals for the grantor. And we do know that the premium in reviewing this to reach maturity increased from $36,000 to $81,000, giving a potential $1.7 million of additional premiums that would be required to reach age 100. And also important to note in this case that if the policy is in force at maturity age 100, the policy cash value is what would be paid to the owner, not the death benefit. And this is important when going into decision making, because if the decision is made to fund this policy to get to maturity, we need to know what happens at maturity, and everybody needs to understand that. So if the decision was made, we're going to pay $81,000 annually for this policy, that all understand that if the insured is still living at maturity and that policy is still in force, only the cash value will be paid to the trust, not the $4 million. So in this case, that $81,000 is just the minimum premium to get that policy to age 100, resulting in essentially less than $1,000 of cash value if that policy is still in force. Now, the third option would be reducing the death benefit to extend the life of the policy. Now, in this situation, it's a bit unique because generally with a universal life policy, there's not an option for contractually paid up policy. That's generally only seen in whole life policies, but we have seen it in universal life policies as well. So in terms of options for reducing the death benefit with this policy, there's a couple options that come into play. One is the standard with the universal policy, is just reducing the death benefit down to an amount that extends it out to a certain age or to maturity. On the flip side, for this policy directly, in the policy contract, there's an option for a paid-up contract. Now, essentially this wasn't offered. Many may have seen Transamerica or any other carrier, their notices regarding COI increases. For Transamerica, they give you on the backside of their form 3 or 4 different options that you can choose or consider as a result. So you could increase premiums, you could do nothing, so similar to what the options are we're going through, or you could reduce the death benefit or surrender. Now, no, they do mention reducing the death benefit. There's no mention in their notices regarding this paid-up option. So this was only discovered after a review of the policy contract, and then inquired directly with Transamerica was a quote delivered. And we'll touch more on that here in a bit. The 4th option would be surrender the policy for the cash value. Now, in this case, based on the amount of premiums that have been paid in and the current cash value, this would result in a large taxable gain to the trust. And to boot that, the beneficiaries really have little need for the cash at this time, and they prefer it stayed in the policy in the form of a death benefit. And then the 5th option would be to sell the policy in the secondary market, and in this case, no offers were forthcoming. Now, to recap these options with the most pertinent options, I guess based on the desires and the current situation of the grantor in this trust. Option 1 is keep the policy as is. You know, ultimately, the $4 million payout would be desired by anybody in this situation, but realizing with the current cost of insurance increases and the potential for, you know, up to $1.7 million of premium just to keep that policy going, it's not really desired by the client. And to boot, knowing that net cash value is what's payable at maturity, you know, presents a different risk, a different liability. And then also, future cost of insurance increases could occur, resulting in even higher premiums that would be required to keep this policy in force. The second option, as we were just discussing, is reducing the death benefit. So now, based on the current non-guaranteed assumptions and no additional premium, the option that was provided by Transamerica was reducing that death benefit down to $3.11, essentially $3,111,675,000. Now, this amount, based on no premium, extended the policy to maturity age 100, based on the net cash value that's currently in the policy covering the monthly deductions. But ultimately, if the insured is living at maturity, age 100, the cash value would be paid, which is, I believe in this case, roughly about $1. And then also the risk to future cost of insurance increases occurring, you know, down the road, which would result in essentially revisiting this entire process and deciding, do we, you know, is it possible to reduce the death benefit even more? How much cash value is remaining at that time? So there's different details that would need to be reviewed at that time. And then getting into a reduced paid-up contract. Now, this option, it reduces the amount of death benefit by almost $300,000 based on just reducing the face amount. What the difference is now this policy would be contractually paid up to age 100, with the cash value equaling that death benefit or fully endowing for $2.8 million at maturity age 100. You know, this eliminates having nothing should the insured live to age 100 and outlive the policy. But there is a cost to it. So we can see that, you know, you have the option of reducing the death benefit down to $3.1 million, or you could actually get a contractually paid up policy for $2.8 million. It's a cost of approximately $300,500, but it's definitely worth considering. Now, in terms of steps and documentation, in this case, after reviewing with the trust beneficiaries, the trustee, along with the grantor/insured, the decision was made to change the policy to a paid-up contract. And the main driving factors in this case, like we just went over, include the recent increase in the cost of insurance charges and the uncertainty of what will happen down the road, and the desire to eliminate a future premium call as a result of that cost of insurance increase occurring. Now, while a case was made for each option, you know, each is valid depending on the situation. All were in agreement in this case that a change to a paid-up contract was a prudent decision based on the facts. Now, prior to any policy change, it's recommended that documentation is prepared that outlines the proposed change, along with all the available options and decision, and then require sign-ups from the trust beneficiaries and co-trustees or any party that are part of that trust. Now in this case, we prepare what we call policy change acknowledgement forms and present to all parties outlining, like I said, the aspects of the current policy, the details, any caveats, all the available options reviewed, and then also the decision that's made. Now these acknowledgement forms are then made part of the trust file, and then the change is processed. So to wrap up this case, just want to reiterate the importance of understanding the policy type and reviewing the policy contract for all available options, some of which may be unknown to even the most senior insurance specialist. Now in this case, the option to change to a contractually paid up or an RPU contract was available, but generally it's something that you wouldn't see in a universal life policy, so it may not be researched or looked at. And even if scanning through a policy contract, you may skim right through that section if you're not, if you're not familiar or you don't know what you're looking for. So it is vital that a life insurance specialist review options, and not just options that they may think are available, but just verifying within the policy contract of any potential options that could be there. Now for our second case, we're looking at a policy that essentially would lapse if a premium was not paid. And this is a survivorship guaranteed universal life policy. The level death benefit is approximately $5.4 million, a net cash value of 0, and a guarantee to age 110 and beyond, assuming planned annual premiums of $240,000 are paid as scheduled. Now this policy relies, just as the policy type, a guaranteed universal, it relies on that no lapse guarantee to sustain that coverage to maturity, and it is heavily relying on that scheduled premium of $240,000 to be paid annually. Now to date, in this situation, approximately $1.2 million of premiums have been paid. Now the male insured is deceased in this case, with the female remaining, who is currently 79 and in good health, and requesting a review as the family is questioning whether these large annual premiums are needed and what other alternative options may be available. Now for this review, options reviewed included the following: paying the scheduled annual premium of $240,000, which is essentially no change. Now we understand that based on this premium outlay, the policy is guaranteed to age 100 and beyond with the maturity extension. Option 2 would be pay no further premium. So we know this isn't a viable option based on this specific policy is so heavily geared on that and relying on that premium that if that premium payment is not paid on that due date, the policy goes into a grace period. Now there are guaranteed universal life policies, and generally most guaranteed universal life policies do have a period where they would continue to provide the coverage with no additional premium for a certain number of years. All depends on how much premium's been paid into that policy, but we do know in this policy that isn't an option. The third would be to invest future premiums versus paying premiums, or allow the policy to lapse, and instead of paying $240,000 in premium, we would then put $240,000 into a hypothetical investment account or some type of investment account. 4 would be to sell the policy on the secondary market. In this case, no offers were forthcoming because of the type and the client health. 5th would be to reduce the death benefit. In this case, this wasn't desired by the client, but still reviewed. And then 6, a policy replacement. And after obtaining informal applications, no more efficient options could be obtained. Now, as far as options, what we're looking at here in this chart is showing several things. So in the first column is the current calendar year, followed by the policy year, then the insured's age. The 4th column is the premium stream, $240,000. The 5th column is the level death benefit. And then the 6th column, what we add in is just a chart to show the cumulative premiums paid. So premiums that have been paid up to this point, and then future premiums. Now this column is added really for comparison to the net death benefit to identify a potential crossover date in the future where that total premium that's been paid in could exceed that death benefit should the insured live that long. Now in reviewing the options, we can see the policy is guaranteed to age 100 and beyond based on the annual premium continuing to be paid. So it's clear that if nothing changes, the $5.4 million death benefit is guaranteed for life. Now, based on the insured's life expectancy, and we can see that with the light blue column that's highlighted in this chart, the insured's life expectancy is right around age 92. And when we go over to the sixth column for total premiums paid, we can see that based on the life expectancy of this female insured living to age 92, if we continue to fund this policy as we are with $240,000 each year, we can see that approximately $4.3 million of premium will be paid at that time, with the death benefit unchanged, as it's a level death benefit with $5.4 million. Now, looking further down to find that crossover point, and when I say crossover, that's when the total premiums paid essentially equal or exceed that total death benefit. We can see right around age 97 is where that'll occur, 96, 97. Now note, this doesn't take into consideration the time value of money. This is just straight $240,000 added each and every year without assuming anything. Now, when we look at option 2, we know, just circling back, that if nothing's paid, the policy will lapse. Now, this policy is being funded with the minimum premium needed to ensure that no lapse guarantee remains active, and there is no leeway in regards to skipping a premium, like I said earlier, that you may see with similar guaranteed universal life policies. If the premium is not paid, the policy lapses. With option 3, what we're looking at is a hypothetical account, assuming that the premium is invested in an investment account, is placed in an investment account versus paying premium. Now with this, we show two or three different columns here at 4%, 5%, and 6%, just giving an idea of what these funds would look like, assuming these hypothetical investment rates. Now, based on this analysis and the insured's life expectancy of age 92, we could see that right around between ages 93 and 94, based on a 6% return, or 95 based on a 4% net return, is how long it would take for that investment account to exceed what would be returned should the insured pass away prior to that point while paying premium. So what's the best course of action in a situation like this, with a policy like this? It's not an easy decision or clear cut, but this type of review provides that starting point for discussion, and it really creates a communication that's needed to make a prudent decision. Now, and these steps include reviewing and updating the policy and trust goals, including are there any health or financial changes, any changes to the overall estate plan, and any potential issues that would need to be talked about regarding paying premiums in the future. Because in this specific policy, we know that if that premium is not paid, the policy is going to lapse relatively quickly. 2 is reviewing your premium options. So in this case, continue to pay the premium or cease paying the premium. It's pretty clear. The third option is just reviewing the alternative options. We could look at, the trust could look at selling the policy on the secondary market if there's an offer available. In this case, there was not. Policy replacement. Informal applications were taken, but there was no desired or no options there for replacement. And then allowing the policy to lapse and looking at investing what would have been put in premium into an investment account. The fourth is deciding on a plan of action. So outlining and reviewing all the options and putting that plan of action in place. And then fifth is documenting the trust file. In this case, the client elects and the family elected to cease paying premium and allow that policy to lapse. So in this example, the documentation was created, outlining the options that were reviewed, everything that was considered, the decision that was desired by the trust beneficiaries, and then upon receipt of all the sign-offs from the beneficiaries, and as directed by the governing trust document, the policy was distributed to the trust beneficiaries prior to the policy lapsing, and ultimately the trust terminated. So note, in this situation, it wasn't the trust that surrendered the policy, but the policy distributed out to the beneficiaries so they could then ultimately allow the policy to lapse. Now, with our third case study, we're reviewing a situation in which the grantor has ceased making gifts to the trust for premium, and a request to surrender the policy has been received from the family. Now, policy details, in this case, we have a $3 million current assumption universal life policy issued in 2004 with a male insured currently aged 83, a net cash value of approximately $818,000, and no taxable gain present. Now this is a fairly common, not necessarily the cash value, but it's a very common request that we see throughout our clients is the request to surrender a policy without really understanding what other options, what are options that ultimately we would have. The trust beneficiaries in this case have no desire or means to pay future premiums, and the trustee is going to review what to do with the policy. Surrender it, reduce the death benefit, leave it as is, sell it, or potentially replace. Now the available options with this policy, and this is just a current assumption universal life policy, include no change or pay premium, I guess in this case we would say. Now with no desire from the grantor to continue making gifts to the trust to pay premium, we know that paying premium is not, more than likely not a viable option. 2 is surrendering the policy for the cash value, which is the initial request that came through. And based on the current cost basis, there is no taxable gain in this policy, which is one of the top things that needs to be researched whenever there's a surrender request that comes in is what's the cost basis, what's the taxable gain. And we even go as far back as looking, was this policy issued via 1035 exchange? Was there a previous cost basis that was carried into this policy? So all those things need to be considered when reviewing a surrender request. The third option would be essentially to allow the policy to run as is, using the current cash value to cover the monthly deductions at the current death benefit, which would remain, in this case, $3 million. The fourth option would be reducing the death benefit to extend the life of the policy. The fifth option, looking to sell the policy in the secondary market. And again, in this case, no offers were forthcoming. And then 6, replacing the policy. And in this case, an informal application was taken, but no more efficient options could be obtained. Now, in reviewing the available options, we know that paying premiums, selling the policy, and replacing are essentially off the table. And we know that paying premiums still remains to be an option, and maybe down the road, selling the policy may come back to be an option. But for now, those 3 options are removed, which leaves us with, to start, looking at surrendering the policy. So in this column, in column 5 and 6, similar to the case study in number 2, we're showing the growth of the cash value, assuming a hypothetical rate of return. And we can see based on these 4% and 6% hypothetical net returns, that the cash value would grow to approximately 1.1, or right around $1.2 million, assuming a 4% return at the median life expectancy, which in this case is age 90. And then at the same, or at the different rate, the 6% net rate of return, we can see the cash value growing to approximately 1.38 million at the insured's median life expectancy age 90. Now also note that there is not a taxable gain on the policy if it was surrendered, just as we went through. Now the option 3, or the third option, is just to allow the policy to run as is with no additional out-of-pocket premium. And as we can see in column 7, based on no additional premium in the current non-guaranteed assumptions, the policy extends to right around the insured's age 91, just over the median life expectancy. So that being noted, we can see that if nothing's done based on the life expectancy of this insured, the policy just goes beyond to age 91. Now option 4 is the reduction option. Now in this case, the carrier provided an alternative to extend the policy to maturity age 100, assuming no additional premiums, with the death benefit reduced to $2,150,000. Now important to note, in this case, the policy does have a continuation rider at maturity, which ultimately means as long as that policy is in force at age 100 and there's a positive cash value, the death benefit, the full death benefit of 2.150 will continue on until death. Now this projection, and it's same with 7, these are based on non-guaranteed assumptions, and it's important to reiterate that these are projections as of today, but would need to be monitored and reviewed each year as we do with all of our policies. Now included with this analysis is in column number 9 is the life expectancy chart. Now, what this shows is the percentage chance the insured or uninsured would have passed away year by year. So this estimate is based on several factors, including the age of the insured, the gender, the smoking status, and any medical conditions, just to name a few. So based on this group of 1,000 people with the same characteristics as this insured, we can expect to, or estimate that 56% of these 1,000 candidates, or these 1,000 people, will be expected to have passed away by age 90. And then we can go through each and see where it all falls. So if we're looking and we get down to around age 93, we can expect about 75, 78% of this pool of 1,000 people would have passed away at that time. So this is a helpful tool to look at when reviewing any options, is the life expectancy of the insured. It's vital. It helps create a point in the future that you can base a decision, or at least the conversation around, and ultimately lead to a more prudent decision. Now, in terms of steps and documentation, similar to each case that we do, you're following very similar paths. You're reviewing the intentions for the policy and trust goals. You're reviewing the options that are available. So in this case, we know surrender and invested cash value is a viable option. No change, leaving the $3 million death benefit, or reducing the death benefit down to an amount that extends, in this case, to maturity age 100. Now, with this initial request from the family, they were set on surrendering the policy. But after going through the options and getting all on the same page so that everybody understands, you do have a lot of options here with this policy. All parties agreed essentially that reducing the death benefit for them was the most desired outcome based on the current situation. So there wasn't a current need for the cash value necessarily, at that time by the beneficiaries, and all agreed that reducing the death benefit would eliminate the insured outliving the policy. Note that the maturity extension played a big part in this, knowing that, assuming the policy performs as projected, which that could change, but based on current projections, knowing that if the insured lived to age 100, they would not outlive this coverage. So just like with the prior cases, document, 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 as Mike said, prior to any changes occurring with any policy, obtaining the necessary documentation is vital, along with outlining those options in that document, and sign-offs from all prior to any policies being changed. Now, while all policies are different, they're very similar. So thinking that you have a universal life policy that functions just like another universal life policy or whole life to whole life is not the case. Each policy needs to be reviewed individually to see what exactly is going on with it. Are there any riders? What happens at maturity? And the carrier. What's going on with the carrier? So it's important that an experienced life insurance professional reviews that policy in that situation.
Thank you, Aaron. We have a couple of really good questions and a comment. I know we're getting to the top of the hour, and I appreciate people sticking with us. One of the things I did want to say is, obviously, the process is the key here, and that's really where we focus. One comment that came in, Ben Baldwin, who is a very, very creative life insurance professional, made the note that the $1.9 million in that first case could have been applied to an optional mode of settlement and create an income stream for the client. And he even put the amount in for 79-year-old would be $190,000 with 40% of it income tax-free. So you're basically annuitizing the $1.9 million, which could be an option. It could be a good option depending on the health of the insured. So I appreciate that comment. And we have 3 quick questions I want to go over. I know we're getting to the top of the hour here. Number 1, can the beneficiaries choose to make the payments if the grantor stops? Absolutely. And as part of your prudent practices, you need to reach out to the beneficiaries and ask them if they would like to. Now, I say absolutely, but you have to check the trust document. But it is a key that you do not surrender, terminate, change a policy without asking the beneficiaries if they would like to contribute. And we do have beneficiaries contributing on policies for their folks or the grantor. How do you go looking for offers in the secondary market? There are life settlement companies out there We do not, we serve the life settlement marketplace. We do not sell, buy policies. We don't do anything that generates a commission. But if anybody would like to name of a qualified life settlement company, there are a couple I know of that are very, very good, that I've dealt with, that are very reputable. So you have to go directly to a life settlement company, and they will be your advocate in the marketplace. And the last question is it important to deliver a policy out to the trust beneficiaries prior to a policy lapse, or is it okay to let the policy lapse within the trust? We've had it happen both ways. My personal opinion is that if somebody's going to allow a policy to lapse and you can get it out and distribute that policy, then it is a smart thing to do. There's something else I wanted to point out about surrendering or allowing a policy to lapse. If you have a life insurance policy with $1 in it and it has a cost basis of $300,000, you can 1035 exchange that into an annuity possibly and retain that cost basis. So your client would then have the cost basis in the annuity. So the value of that life insurance policy that might be lapsing might be in the cost basis of the policy. So it's something else to consider. But I appreciate the input. Those were great questions and a great observation by you, Ben. I appreciate that. Thank you, Aaron, for your input, and I appreciate everybody being here today. We have another session coming up in November, and then one in December to close out the year, and we have some interesting ideas coming for 2017, including some client-only sessions and some more interactive sessions. One more question says, who can we contact regarding a list of life settlement companies you recommend? You could contact me. That's M. Brohawn at IPM 21st. M. Brohawn, B-R-O-H-A-W-N, at IPM21ST.com. So again, thank you everyone for taking part today. If you have any other questions, you can certainly reach out to Aaron or to me. And again, we appreciate your time today. Thanks a lot.